Mutual funds are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of securities such as stocks, bonds, and other assets. They are managed by professional fund managers and offer individual investors an opportunity to access a diversified portfolio without directly buying and managing individual securities. Mutual funds provide various types, each with its own investment objectives, risks, and performance evaluation metrics. Types of mutual funds. Equity funds. These funds invest primarily in stocks or equity-related securities. They aim to generate capital appreciation by taking advantage of potential growth in the stock market. Equity funds can be further categorized into large cap, mid cap, small cap, sector-specific, and index funds. Fixed income funds, also known as bond funds. These funds invest in fixed income securities such as government bonds, corporate bonds, and treasury bills. They aim to provide regular income through interest payments and preserve capital. Fixed income funds can be categorized based on the duration of the bonds they hold, such as short-term, intermediate-term, or long-term bond funds. Money market funds. These funds invest in short-term, low-risk debt instruments like treasury bills, certificates of deposit, and commercial paper. Money market funds aim to provide investors with stability and liquidity, making them suitable for short-term cash management and capital preservation. Balanced funds. These funds invest in a mix of stocks, bonds, and sometimes cash equivalents. Balanced funds aim to strike a balance between generating capital appreciation and providing income and stability. The allocation between equity and fixed income securities can vary based on the fund's objective. Index funds. These funds aim to replicate the performance of a specific market index, such as the S&P 500 or the FTSE 100. Index funds typically have lower expense ratios compared to actively managed funds since they do not require extensive research or stock selection. Specialty funds. These funds focus on specific investment themes or sectors, such as technology, healthcare, or real estate. They aim to capitalize on the growth potential of a particular industry or sector. Risks associated with mutual funds. Market risk. Mutual funds are exposed to market fluctuations, and the value of the fund's investments can go up or down based on the performance of the underlying securities. Investors may experience losses if the market declines. Credit risk. Funds investing in bonds or other debt instruments carry the risk of default by the issuer. If a bond issuer fails to make interest payments or repay the principal amount, it can impact the fund's returns. Interest rate risk. Bond funds are sensitive to changes in interest rates. When rates rise, bond prices generally fall, leading to a decline in the fund's net asset value, NAV. Conversely, falling interest rates can increase the value of bond funds. Liquidity risk. Some mutual funds, especially those investing in less liquid assets, may face challenges in selling securities to meet investor redemptions, particularly during periods of market stress. This can lead to potential delays or limitations in accessing invested capital. Managerial risk. The performance of a mutual fund is heavily dependent on the skills and decisions of the fund manager. Poor investment decisions or ineffective management can lead to underperformance compared to the market or peer funds. Performance evaluation of mutual funds. Returns. One of the primary ways to evaluate mutual fund performance is by examining historical returns. Investors typically compare a fund's performance against a relevant benchmark index and peer group to assess its ability to generate returns over different time horizons. Risk-adjusted returns. It is essential to consider risk-adjusted returns, which take into account the level of risk undertaken by the fund to achieve its returns. Metrics like the Sharpe ratio or the Sortino ratio help evaluate a fund's performance relative to the amount of risk it assumes. Expense ratio. The expense ratio represents the annual fees and expenses charged by the mutual fund. A lower expense ratio can contribute positively to a fund's overall performance, as high expenses can eat into the returns generated by the underlying investments. Portfolio composition. Understanding the composition of a mutual fund's portfolio is crucial in evaluating its performance. This includes analyzing the asset allocation, sector exposure, and individual securities held. A well-diversified and balanced portfolio can be an indication of prudent investment management. Fund managers' track record. Assessing the experience, expertise, and track record of the fund manager can provide insights into their ability to deliver consistent performance. Consistently outperforming the benchmark index or generating above-average returns can be indicative of a skilled manager. Fund size and liquidity. The size of a mutual fund can impact its performance. While smaller funds may have more flexibility in selecting investments, larger funds might face challenges in efficiently deploying capital. Additionally, the liquidity of a fund's underlying securities should be considered, as it can affect the fund's ability to execute investment decisions. When evaluating mutual funds, it's essential to consider these factors in combination and align them with your investment goals, risk tolerance, and time horizon. Consulting with a financial advisor can provide personalized guidance tailored to your specific investment needs.